Equities looking okay here, about 20 seconds away from the opening bow this morning. Good morning to you. Futures positive 0.4% on the S&P. Breaking back up. The Nasdaq 100 up by about 0.7% there. 4,200 the line in the sand on the S&P 500. For a number of months now, we've all got one eye on that around the open. There's your opening bow. Switch on the board and get to the bond market. Yields look a little something like this, unchanged on a 10-year, 359.47. Yields unchanged. Euro dollar just about unchanged as well. No drama here. Positive 0.2% at 109.50. And crude going absolutely nowhere. $80 and about 85 cents. 15 seconds into the open. The S&P 500 positive 0.4%. The broader Nasdaq up by about 0.6%. Two stocks to watch at the opening bell. Bank of America and Goldman. Two banks, two very different realities. B of A delivering a profit. B as Goldman misses out on the fixed income boom. Abby has more. Hey, Abby.
Hey, John. And yeah, that fixed income situation, that seems to be the real difference between Goldman Sachs and not just Bank of America, but the other big banks as well. So Goldman Sachs, of course, the stock is down today. Bank of America is higher as Goldman Sachs's fixed income misses the mark and down about 17% on a year-over-year basis, whereas Bank of America really blows it out of the water. Let's take a closer look at Goldman Sachs, though, a broader look, because their equity business actually beat. And so overall earnings were a beat as well. Sales were a bit of a miss. What we do have, though, is a higher bar proving challenging because this company has really outperformed over the last year. And one point around this, it is basically flat over the last year, the stock, whereas Bank of America is down about 20% over the last year. They also did show that headcount reduction, probably a little bit more aggressive than what people had been expecting. Bringing Bank of America into the story, they really beat right across the board. Sales, earnings, FICC trading. That FICC trading beating by 31%. Net interest income for Goldman Sachs, on the other hand, missing by 19%. If we take a closer look at the FICC miss, because that really seems to be what's weighing. Last year, for their first quarter, they put up $4.7 billion in FICC trading. This year, $3.9 billion, again, a 17% decline thereabouts. So the stock is down. But again, remember, Bank of America underperforming over the last year, Goldman Sachs outperforming, so a little bit of an evening here.
Also worth pointing out as well, that move on Bank of America might not look like much, up by about 0.8%, but over the last couple of days, decent rally put together on Friday after the JP Morgan numbers, up by a little more than 3%. Yesterday, up by close to 3% as well. This morning, of course, up by 6 or 0.7%. Goldman lower by 3.5%. Abby, thanks for that. Working through some of the big names this morning. Morgan Stanley, the final big name to report tomorrow morning. Looking forward to that before the opening bell. I want to turn to the smaller banks just briefly. BNY Mellon's first quarter deposits topped analyst estimates. The company's CEO said this: time and time again, BNY Mellon has been a port in the storm for our clients in times of market turmoil. Shonali Bassett wraps it all up for us. Hey, Shonali.
John, it's amazing how many banks we're looking at this season. You have Bank of New York Mellon really showing you a different story from State Street, but we have a host of regional banks ahead. If you take a look, there are very big differences in what is expected from deposit outflows. But I've got to say, if you look at the banks that have reported so far, it's not just a deposit story. It's a profitability story and the ability of these banks to lend. Just take a look at what happened at M&T yesterday, for example. The deposits missed slightly on estimates, but their net interest income was able to meet or beat expectations, even with some provisions for loan losses. So really, the health of these banks is a real question. If you take a look at those estimates on deposits, a lot of these differentials are regional. Western Alliance are expected to report after the market today, Phoenix-based Western Alliance. Then First Republic, and we've talked about this a lot, we're not out of the clear for this system here until we hear from First Republic early next week. And so you see U.S. Bancorp, PNC Financials, the larger of the regionals, really holding steady on the deposit picture, really comes into line with what Bank of America is saying here, that pressure on deposits is still there, but it's starting to ease a little bit. Now, the big question in the market is how sticky are deposits overall. JP Morgan says not very sticky. Bank of America is saying pretty sticky. So does the consumer story give some love to these banks that have been so poorly beaten in the stock market up to this point this year?
Shonali, thank you. The regional banking story there, just a bit softer by 5 or 0.6%. Shonali will, of course, drop by tomorrow morning to work through some of those regional bank earnings we get this afternoon, and Morgan Stanley coming up before the opening bow tomorrow too. Back with us now, I'm pleased to say, Stephen Bigger of Argus Research joins us to talk about some of these names. Stephen, great to catch up with you, sir, as always. I was going through some of your calls before the program. Bank of America, buy. JP Morgan, buy. Morgan Stanley, Citi, Wells, buy. Do you like what you've been hearing over the last week or so, Stephen?
Well, yeah, so far so good. I think, there's been a 100% beat rate. If you take out some of the asset custody banks like State Street yesterday. And yeah, these have been, pretty good results. I mean, I think banks have demonstrated the power of diversification basically in the large banks that you mentioned. Some of the smaller regional, even mid-sized regional, I think are going to have a tougher time coming up with earnings yet to report. This deposit conundrum that banks are facing right now with some outflows is going to be watched pretty closely here. But yeah, the large banks, I think the trading's still doing well. Investment banking has been weak as expected. Net interest income probably the peak for the year this quarter though. Facing some deposit, some margin pressures as the year goes by.
One name underperforming this morning, it is Goldman Sachs. Now, Stephen, that's one name I didn't mention next to the word buy. From you say hold. Where did they fall short for you, and was that validated by what you saw in the numbers this morning?
Well, yes, it does. I think our whole recommendation is that Goldman is still, as old as the bank is, I hesitate to say, still trying to figure themselves out. They're, an investment bank and trying to tack on a consumer bank on top of it, and they're thirsty for those low-cost deposits, or which had been low-cost deposits, up until 6 months ago. So, this is a bank that is, Goldman is very reliant on trading and investment banking. In fact, what I would say that every quarter they wake up and they have to earn probably 60% of their revenues in terms of trading and investment banking, whereas your larger global peers wake up with probably 80% of the revenues kind of already in the bag in terms of net interest income and other transaction banking. So it's a work in progress with Goldman. The sheer volatility, I'm afraid, results in a perennially lower PE and other valuation multiples, and I think that's the thing that they have to overcome. Just get more consistent on those return on equity targets in order to be more comfortable with the buy recommendation.
Just say about 7 minutes into the session, Goldman's still underperforming, down by about 3.5%. If you look at Bank of America, it was positive by 6 or 0.7%, just turning negative by almost 1% just moments ago. Stephen, I just wonder, you don't just cover the big names, you cover some of the smaller names as well. When we get to the end of the quarter and you've heard from all the names in your coverage, what's the headline you expect to write? That the big banks crushed it or the smaller banks got crushed?
So I think it's the big banks crushed it. There has been a flight to safety in the industry here. Deposit flows still favoring the large banks. And, the industry itself has to really figure out this deposit situation. They either want to chase those deposits and pay up for higher rates or not. And I think to date they've not. And the reason is that deposits are still above where they were pre-pandemic. The industry had a flood of deposits during the pandemic, and I think they have room to wear those deposits off a little bit before they start to worry about having to either up rates to attract more deposits or to have to borrow funds, which they also can do in the open market. But yeah, the big banks I think are the place to be, as well as I would add though the super regionals, the Truist Financial, PNC, USB. These are all banks very well positioned, great national or near national franchises, great deposit bases, and again very good diversification in their business models. Smaller regional banks, if your only bread and butter is really lending and you've got a fair amount of commercial real estate mixed in there, I think you're in for a much tougher year.
It's going to be a tough time. Maybe we see that in the numbers a little bit later on this afternoon. Stephen, thanks for that. As always, Stephen Bigger there on a busy morning for him with some of the big banks reporting this morning, and then a little bit later on this afternoon, the regionals really kicking things off with Western Alliance. Schnally's talked about that a few times. Your broader equity market about 9 minutes into the session, positive 1/3% on the Nasdaq, up almost 1/2%. Sarah Hunt of Alpine looking for signs of an earnings slowdown. She writes this: recent estimates do not seem to be showing an anticipated slowdown usually associated with a recession. Do they need to come down further? That is the biggest question of this earnings season that has just begun with very good numbers from big banks. Sarah joined us right now. Now, Sarah, I guess ultimately comes down to whether you think there will be a recession or not. Now, where'd you come down on that?
I think it's really hard to tell. I think we're still all working through data. I think you just saw some slowdown in housing data. I don't disagree that even though we've been arguing about when these long and variable lags come in, that they are actually coming. I look forward to seeing the senior loan officer survey in May. But I have to say that it's hard to believe that credit doesn't contract or that people don't make as much investment when you have to pay 5 or 6% than when you were paying 1 or 2% or 3%. So I just don't see that we really worked through that yet. And I think that the market seems to be anticipating cuts by the Fed before we're even done with this tightening cycle. And I think that the Fed will probably stay higher longer as long as there isn't underlying problems in the economy because of the higher rates.
What do you make of these comments from the St. Louis Fed president to Reuters in the last 20 minutes or so? The labour market just seems very, very strong. The conventional wisdom is that if you have a strong labour market, that feeds into strong consumption, and that's a big chunk of the economy. It doesn't seem like at the moment we should be predicting that you have a recession in the second half of 2023. Is that something that resonates with you, Sarah, something you'd push back on?
Well, I think, this has been the biggest anticipated recession in quite some time. So people have been looking for this. And I don't disagree that the labor market has held up very well, but it's hard to figure out if it's held up really well because of the previous payments that people received during the pandemic and or the fact that people had to rush to staff to get things together. And wages don't seem to be accelerating as much as people had originally anticipated that they would, and you still have a lot of people out of the labor market. So the question is exactly how tight that is and whether or not wages are actually going to go up. I think you've got a lot of questions about where margins are going to go, and that's a little bit about labor pricing. I don't know when this happens, but clearly like the extension on timing has come through here because we were earlier last year, people were anticipating a slowdown in the first half. We always thought it would be the second half, and now it's hard to figure out whether or not that's being pushed out even further. But I think it is coming, and I think that that's where the equity markets are sort of anticipating that we've already gotten through that.
Is the juice worth the squeeze? Marko Kolanovic over at JP Morgan says it's not. He says the following: even a mild recession with warrant retesting the previous lows and result in over 15% downside. He went on to say, we view this rally as irrational. We continue to believe a recession is likely this year. If I asked you that, Sarah, then ultimately is the juice worth the squeeze? Is the upside worth chasing given the downside that could materialize?
I think from where we are now, I have to agree with him. I think it's very difficult to go chasing it now. I think that's, we came into this year, people were very much positioned for a slowdown. That didn't happen, and you got very good earnings, and you got very good numbers and some good economic statistics. And now the question is, from here, what makes the market go higher? I think the anticipation has been, well, the Fed cuts rates and demand gets higher. I think, good news out of China this morning, that was helpful for markets because growth somewhere else is still growth globally. But I do wonder where we are now versus where we should or could be in the next few months, given what may come through on some slower earnings and some, I think, slower economic statistics. I think, look at the housing numbers this morning. I think that's not a trend yet because that's just 1 month. But the fact that you're seeing the slowdown, I think that that's finally coming through because of higher interest rates.
Where does that leave the energy trade, Sarah, that I know you love?
Well, I still do like the energy trade. It's been very challenging, although the recent uptick in oil prices on the back of the Saudis cutting isn't necessarily something that you want to see those prices go up because of cutting. You want to see better demand. I'm not sure that the China numbers are good enough to help demand right now. I think globally, if we have a slowdown, that's tough on energy demand, but at the same time, you have a supply problem because you haven't done enough investing. So I still think that there is good value in the energy trade. I think you can clip some nice dividend coupons from some of your big integrated. We happen to like Chevron of those, but I think that there are also some plays in natural gas. I've mentioned Chart Industries before. They had some good numbers and put up a nice backlog. I think there's some nice places in that space to play because this transition that everyone's talking about and the expense that that is going to cost is going to mean that there are beneficiaries of that. And to the extent that some inflation is self-inflicted because we want to transition away from hydrocarbons, that's also part of the larger story that I think is difficult to figure out exactly how that plays into all the other inflationary numbers.
Sarah, when some of those majors report, let's catch up again later on this earnings season. Sarah Hunt, the brilliant Sarah Hunt of Alpine Saxon Woods. The underlying commodity, crude right now, still just about holding on to the 80s, $80 and about 50 cents on WTI, softer by about 0.5% on the session. If you're looking at Brent, 84.36. We're negative about 0.5% there. Just want to check in on the bank earnings for you, or rather the price action off the back of the bank earnings. Bank of America just about unchanged on B of A. B of A just about unchanged to down 0.1% after opening up positively a little bit earlier this morning. Goldman still trading lower by 2.65%. The broader market up by 1/3%. Coming up on this program, Apple teaming up with Goldman to debut a high yield savings account.
Goldman Sachs, I think, is desperate to attract deposits there. Apple is basically only a brand name on top of it. Let's be frank about that. It's really Goldman Sachs doing all the work in the background.
That conversation up next.
4% on a savings account is quite a hefty amount of interest compared to many of the other large banks are offering. So Goldman Sachs, I think, is desperate to attract deposits there. Apple is basically only a brand name on top of it. Let's be frank about that. It's really Goldman Sachs doing all the work in the background and sort of putting the Apple logo on the top of it. So Apple's involvement there is really branding only.
Apple and Goldman joining the race to lure depositors, teaming up to launch a savings account with an annual yield of 4.15%. This is Apple opens its first store in India. The CEO, Tim Cook, saying during the company's latest earnings call, India is a hugely exciting market for us and a major focus. I'm very bullish on India. Ed Ludlow joins us now on the West Coast. Ed, two stories there. Let's start with the first one. This Goldman-Apple combination, what's the push all about?
The push is all about bringing users who are not hardware users into the ecosystem through the attraction of services, right? It was interesting, the comments of that soundbite. You have to be an Apple Card user. You have to be in the United States. The Apple Card is created by Apple, but it is issued by Goldman Sachs. You know, Apple notes in their statement that 4.15% yield is 10 times the national average. I think I was talking with some colleagues about this morning. Surely in the near term, this isn't a moneymaker for Apple, but think about all those people around the world that do not have an iPhone or do not use a MacBook. The attraction of a 4.15% deposits account in this week of all weeks, John, when we're looking at deposit data from the biggest and the smallest banks, longer term, the play for Apple is to really pump that services side of its business, and think about the data that they can get access to in offering something like that, particularly those customers that they don't have data on from the hardware.
How does it complement the broader push then, I think, is the broader question, ultimately then, Ed, and the stickiness of the ecosystem that Apple is offering? Is this just a supplement, a way of complementing that effort?
Yeah, I don't know what you get on your savings account, John, but I get, what, 0.01% currently?
Something
so I think
close to zero.
Yeah, so I think 4.15% turns a few heads. You know, think about that, the attractiveness of that offer. I guess my point is, you can bring in new customers who are not iPhone users, who are not MacBook users. They get exposure to the banking or financial services from Apple. That introduces them to other services from Apple, which may lead to them becoming hardware customers as well. This isn't a huge surprise. Remember, they announced the initiative back in October. They're just putting flesh on the bones of that strategy. But 4.15%, as your guest said, is also a Goldman story, because Apple is not a bank, it's just the brand.
And as someone pointed out, Apple's just a wrapper for the Goldman product, but the tension comes with the very fact that you can get more on your Apple yield than you can from Goldman in Marcus, even though Goldman is backing the Apple effort. Makes sense of that. Ed, thank you, buddy, as always. Ed Ludlow there on the West Coast on the latest with Apple. Two big pushes there. The financial side of things and in India. Big push in India we'll talk about in the months to come. I want to talk about Netflix. They report after the closing bell. Guggenheim expecting new subscribers to top estimates. The analyst writing this. A positive outlook is driven by the anticipated impact from recent international price cuts in certain markets and slower than previously anticipated rollout of password sharing. Geetha Raghunathan joins us now, Bloomberg Intelligence. Geetha, to you. What do you expect a little bit later on this afternoon?
Yeah, absolutely, John. So it's been 1 year since the great Netflix meltdown and the correction. I think overall the sentiment is so much better, but it's probably going to be a little bit of a mixed bag as we head into this quarter. So Netflix has actually stopped issuing subscriber guidance, but the street is looking for about 2.4 million subscriber adds for 1Q. We think it actually comes in slightly better than that. But again, remember, this quarter is a little bit tricky. You have too many different things going on. As you just mentioned, there's the new advertising tier that was launched. We have this password crackdown efforts that they're kind of implementing market by market. And then they did implement price cuts in about 100 emerging markets. So you have all of those different balls in the air. We're expecting positive commentary on all of that. I think where the market and where investors might be slightly disappointed is if Netflix kind of walks back. So what they had said initially was that in 2Q they were expecting this major inflection in subscriber trends. But if they walk that back on the back of, password sharing, just because there's a lot of volatility when you kind of implement password sharing, I think that's where, investors could potentially be a little bit disappointed.
I have to say I'm pleased they no longer offer guidance around subs, because they were terrible at offering guidance around subs, which were way out of whack with the actual numbers. Geetha, thank you. As always, we'll touch base with you tomorrow morning after we get the earnings a little bit later on this afternoon. Look out for the coverage from Ed Ludlow and Caroline Hyde at about midday Eastern time. A couple of hours from now, they'll pick up on that story. Abby, let's look at the price action together. Just briefly, the sector price action. Over to you.
Well, we do have the S&P 500 slightly higher. The best sector is technology, up 1%. The worst, healthcare, being weighed on by Johnson & Johnson, down 0.4%. Most interesting, John, is the fact that we have volumes above average for both the S&P 500 and the NASDAQ. It has to do with that tech strength and the chips. Chips outperforming on the day, John.
Abby, thank you. The equity market up 1/3%. Your trading diary up next. 26 minutes into the session, just about positive on the S&P by a third of 1%. Let's get straight to the trading diary. Coming up shortly, Fed Governor Michelle Bowman, 1 p.m. Eastern Time. Netflix earnings after the close and results from some of the regional names, First Horizon and Western Alliance, just two of them. On Wednesday, Morgan Stanley reports earnings, plus we get the Fed's beige book, another round of jobless claims on Thursday, and more Fed speak. Waller, Mester, Bowman, Bostic and Harker. And we round out the week with the US PMIs on Friday. That rounds out the morning for me. Good morning to you all. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, April 18th. It's tax day. Here are the top market stories we're following for you at this hour. BofA flexes its muscles. Bank of America tops estimates as FICC trading soars almost 30%, helping the bank make over $14 billion in net interest income. That stock up over 2% in 2 days. And Goldman's FICC atrophies. The Wall Street giant misses the FICC boom with revenue falling 17%, while markets muddies the profit waters. The stock falls the most since March banking crisis at one point. We're off the lows, though. And the biggest pain trade, Bank of America says if recession doesn't materialize in the second quarter, the pain trade is a rally in bonds and bank stocks. Its latest fund manager survey shows bad sentiment versus a consistent bid in the equity market. From New York, I'm Alex Steele with Danny Berger in London. Guy Johnson is off today. Danny, if we just look at the headline index, it doesn't really tell us that much of anything. You have the NASDAQ up a little bit, you have the Dow down a little bit, the S&P kind of goes nowhere. But on an individual individual basis, whether you're looking at Goldman, B of A, or even NVIDIA with a double upgrade, that's where things get interesting.
Yeah, underneath the headline index, it is strange, shall we say. I should say, Alex, by the way, the headline index for the S&P 500 trading at multi-month highs, despite underneath the surface, look, it isn't rosy for all banks. Goldman certainly showed us that, but one thing we have to grapple with is this Goldman specific, or are we starting to see a divergence, a wider divergence among the big banks?
Yeah, well, and also, is it more about individual names now as we're in earnings season and kind of a bottom-up perspective versus the macro? I mean, you had Bullard talking about how he sees more rate hikes today, and the bond market didn't even move. You're seeing a little bit of a bid even come into the bond market. If it's really the bottom-up, if you can still make money, you can still be profitable, you're going to go buy them. But sentiment still is really bad. So then at some point, is there going to be that kind of capitulation where you have to chase it because all of a sudden your clients are going to be like, hey, why am I losing out to the S&P right now?
Yeah, clients even on the sell side asking, hey, Morgan Stanley, hey, JP Morgan, why are you still so negative when equities are doing just fine? In fact, the NASDAQ continues to trade at year-to-date highs. And again, Alex, it is the banking story that might shake things up, make us question, should we be buying some of these individual shares and not the overall index? It has been a tale of two banks. Bank of America topped estimates with fixed income trading driving profits. Goldman, on the other hand, as we've been saying, failed to capitalize on that bonanza. Here are the two CEOs on their analyst calls this morning.
As you think through all the tightening actions of the Fed, the flows to alternative yielding assets, investments, and the disruption of the past quarter, our deposits continue to perform well.
While it's impossible to predict the exact form a market stress will take, and we won't always execute perfectly, our risk management culture, strong liquidity, and robust capital position have allowed us to navigate a complex environment while also continuing to actively support our clients.
Now, these divergences bring us to our question of the day. Is stock picking back? Can you buy just the index at this point in time? Joining us now are Bloomberg Shonali Basak and Kriti Gupta. Shonali, we'll get to this in terms of individual banks in a moment, but Kriti, I want to start with you in terms of this environment. It's a cliche at this point, but you know, cliches exist for a reason. Sometimes they are true. Is this a stock picker's market right now?
I mean, everyone's been saying that for, I want to say, at least 2 years now, that when you are looking at an inflationary environment or supply chain issues or even the COVID-19 pandemic, look at the companies that are best positioned. You want to hop into high-quality names. I mean, to your point, Danny, the cliches are ongoing. But look, it might just be, and the reason I say that is because at the end of the day, if you're looking at the way this market is trading, there are no macro themes anymore because every kind of individual stock has approached the massive amount of cash on their balance sheets in very different ways. I'll give you some examples here. If you're looking at, say, even the tech space, which seems to be the no-brainer, it is no longer an environment where we're saying, look, yields are coming down because the Fed is perhaps ending their tightening cycle, and therefore buying tech is a no-brainer. No, you can't think of this market that way. That's a 2022 or even 2021 way of thinking. You have to now look at, okay, well, Apple is dealing with their supply chain issues in Asia. Tesla is dealing with competing with Ford and GM on their pricing. Those kind of things matter because the Fed is no longer the macroeconomic driver. This is something that Mike Wilson over at Morgan Stanley warned about last October. He said at some point it's going to go from the macro to the micro. He just missed his timing a little bit. 6 months later, that's starting to kick in.
And that brings us to sort of those two bank CEOs, Shonali. I mean, I appreciate that Solomon was trying to sound upbeat, but when you say things like, we won't always execute perfectly, for the CEO of Goldman Sachs to say that, that means, hey guys, we messed up. There was some stuff going on.
Interesting here is some fascinating things in the trading business in particular. One, this FIC number, even though it came in below expectations, it is still the third best number that Goldman has had in 10 years. It also is part of the market here where commodities, they had a gangbusters commodity quarter last year at the start of the war, really creating that commodities super cycle, if you will. But now remember, interestingly here, Goldman Sachs' CEO is getting a question on the call from Christian Bolu of Autonomous Research about the hedge fund closures and the pain on the buy side and to what extent that is impacting Goldman Sachs and, of course, its rivals. Now, at Goldman Sachs, the equities revenue here only fell about 7%. Remember, there's been virtually no new issuance. At JP Morgan, that was about 12%. And if you take a look here, not only is there not as much new issuance, there's that issue that the analysts are bringing up, pain on the buy side, and the numbers themselves, even though you have funds coming coming back this year. Hedge funds starting to do better in equities. Long short funds doing much better than the long short funds, the long bias funds. You still have them not really recovering from how much pain they had last year. And what's worse here, Alex, you also have returns becoming more muted into this year. So banks can only do as well as their clients do in this volatility type of trading. And remember, you also have David Solomon saying today that the volatility is starting to cool off from really some crazy levels that we have seen under the surface here on the wake of some seriously wild events, let's say, in the market.
Shonali, one thing, though, the bank can control that doesn't necessarily depend on its clients, I mean, maybe in part so, but is costs. How did Goldman fare on that front?
Now, remember what's interesting here, Danny, is that you have Goldman's headcount reduced relative to where it was last year, and you have JP Morgan, Bank of America, and Citigroup all seeing increased headcount. Now, that's for different reasons, but something interesting is, and people forget this, that Goldman, especially when it comes to those trading desks and its investment bank, they have made investments in technology very early on, whereas now Citigroup has spent money to have 8,000 new people in technology as it catches up and meets consent orders and other technological issues. Now, that gives you a return on the trading desk at more than 16%. So the returns still look good on the trading desk because, again, they have made serious investments to meet the clients. But what happens, and this is kind of what we're talking about here, what happens when the market starts to cool? Your biggest money makers start to come under pressure, and you've got to wonder if it happens for Goldman today, does it start to happen for everybody soon?
Right, and then, but this also brings me to the stock picker point, and Kriti, your point as well, is that I wonder how much of this is going to become a consumer-led story. In that, you're going to want the big consumer-exposed banks, the JP Morgans, the Citi, and the Bank of Americas, to also help offset the situation that Shonali is talking about. This also echoes over in Europe as well, when you see luxury retail doing so well over in France because of exposure to China. Like, it feels like in some ways it's becoming a macro plus micro story for the consumer here.
It absolutely is, and I think the show actually hit that point last week when you're talking about the top line versus the bottom line. For so long, the bottom line has been what's been driving the stock market. Now really it's the top line, Alex, to your point. At the end of the day, it's the consumer, but I really want to underscore the point that Shonali just made. When you look at the divergence between the trading revenue of Bank of America and Goldman Sachs, this is a perfect example of the idea that you just outlined, Alex, the idea that the macro, even though we're looking at bond volatility for the last quarter, two different banks, both in theory should have benefited, and both in theory did. As you saw those yields really move, the expectation was, well, the first quarter was going to be good for some of these market makers for that reason. Two completely different micro stories about how Bank of America versus Goldman Sachs handled that macroeconomic environment. And I think that's really where, to your point, the macro meets the micro. You're seeing this in other sectors as well. You're seeing this, I mean, I mentioned technology earlier. You're seeing this in defense. Lockheed Martin, for example, reporting earnings this morning. You're seeing this in healthcare with the M&A consolidation. People are now saying, look, we know that the macroeconomic environment has been tough for a couple of years now, arguably, and we don't really have clear timing. So we're going to handle this in very different ways because the baseline scenarios, we have a lot of cash on our balance sheets. Rates are going to be staying higher for longer, at least according to what the Federal Reserve is telling us. Now, what do we do with that? Some people are saying we need to diversify, we need to buy more, we need to acquire more. Others are saying we need to diversify our supply chain. Some people are saying, look, start diversifying away from the consumer. Lockheed Martin, for example, leaning towards more government contracts, Boeing leaning away from government contracts. It's a very different sphere, and that's why I think the cliches are coming true. To Danny's point earlier, it is becoming a stock picker's environment because it's now becoming a far more nuanced macroeconomic environment.
Right. Well, speaking of that, Shonali, just 60 seconds here, less than 60 seconds, I should say. Part of what's happening and what Kriti is describing is that equities in the latest Bank of America survey versus bonds, that allocation is the lowest since the great financial crisis. How does that play through in what you're seeing from these banking results?
Yeah, that there is no alternative story is really starting to go away. If you think that equities funds were up about 2% this year, credit long-short funds, Danny, were up 5.5% this year. So, you know, there's a question about whether this is a time for fixed income, even if you have other alternatives in money markets that are giving you 5% or more. Is it a fixed income market? Is it a bond picker's market more than a stock picker's market?
Oh, that's interesting, especially when it was BlackRock called it 60-40's dead, so that's actually an interesting take on that too. Guys, thanks a lot. We really appreciate it. Great way to set up the show. Shonali Basak and Kriti Gupta, thank you very much. All right, coming up, Apple opening the doors to its first retail store in India as the tech giant looks beyond China for growth. Details on the startup next. This is Bloomberg. It is 12 minutes past 7 on the West Coast. Want to get to the startup. Ooh, that looks beautiful. Some way we cover the top tech stories from the Bay Area and beyond. Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, let's just start with Apple here, opening its first stores in India, the significance, etc. Lots of fanfare.
Yeah, lots of fanfare. You know, India is a ginormous country, 1.4 billion people, but for Apple, it's a market where the higher price points have not resonated with the consumer, right? When you consider the sort of median household income there. Tim Cook was in Mumbai. As Bloomberg reported, he would be opening the store. He literally opened the doors to all the fans that rushed in. There is a second store opening in New Delhi. Apple's had like the online store open since 2020, but this is their first physical store. And as we reported earlier this week, it's definitely a market that's growing traction. You know, the 12-month period through March, according to sources, Apple booked about $6 billion worth of sales, which is a 50% jump, 50% jump from the same 12-month period a year earlier. So there's growth there, but it's still a very small percentage of markets globally.
And how much of this is also about politics, of not just making themselves very present in the consumer side of the Indian market, but also production and a shift away from China? Mm-hmm.
Yeah, you can use SPLC on your Bloomberg. I think we even have a Maps Go going, but it's about 1% of products are assembled or manufactured in India, 98% of that being in China, right? And we've talked about Apple trying to de-risk its supply chain, diversify towards India. There's an interesting component in India as well, which is that there are local laws which require products sold in the country to have a certain proportion of parts sourced from within its economy. So India too is kind of influential. There he is, Tim Cook, Mumbai, having a nice time overnight. But, you know, it goes hand in hand. There's definitely a growth story with the consumer. And I think if you look at our Bloomberg Intelligence analysis and forecast, by 2030, they see real high double digits growth going into that economy for Apple. with the supply chain localization helping as part of that effort.
Hey, Ed, before we let you go, Danny and I were able to watch our Love is Blind reunion, season 4 yesterday. We felt like we connected on that. We have clarity. I say that because Netflix is reporting after the bell today, and it was a huge issue that it couldn't live stream that because that's what they're trying to do. They're also dealing with password sharing and also ad sales. What are we going to expect today?
Yeah, I mean, Netflix was pretty significantly lower yesterday, right, following Sunday night's situation. I think that there is, beyond that, Nick Lachey or otherwise, there will be a focus on advertising. You know, the two major things that have changed since Netflix last reported earnings is a real push into an ad-supported tier of subscription and a crackdown on password sharing. So, look, Nick's sleeping. He's bored with what I'm saying. But, you know, there will be, I'm sure...
They're mocking the pods is what's happening. But you have to know the show. But okay.
There will be a post-mortem on what happened Sunday night, but that really is the focus for the street. Advertising and password sharing crackdown.
I would just like to note, here we are, the year of our Lord 2023, and Ed Ludlow is talking about Nick Lachey on Bloomberg TV. What a time to be alive. Ed, thank you so much. It's Bloomberg's Ed Ludlow. And of course, you can catch Ed as co-host of Bloomberg Technology coming up in around 90 minutes time at noon Eastern, 5 p.m. here in London. Now, still ahead, pharma giant J&J modestly lifting its outlook for the year, thanks in part to consumer demand for Tylenol, Motrin pain relievers. We're going to talk to the company's CFO, Joe Wolf, next. This is Bloomberg.